Hi guys. Welcome back to my channel, the best place for who wants to be a better player in the global market. In this video, I'm showing types of import-export insurance. I think you are going to get some really good ideas. The possibilities are truly endless when it comes to building your business and be your own boss. The whole purpose of being in business is to trade items for a profit, and this may not be possible if the trading items get lost or stolen before getting to their destination. Unfortunately, both seasoned and novice businessmen often forget this basic fact and pay the ultimate price. When you fail to take out cargo insurance for your import or export shipment, you are in fact setting yourself up for disaster. Reasons for export-import goods insurance. Even though import insurance cost might be considered expensive by many traders, the import-export trade domain faces certain issues that are not encountered anywhere else and that make it essential to take a suitable sort of cover to mitigate inevitable loss. 1. Limited liability clauses. Courier services that operate air and ocean freight services do not extensively cover your consignment while it is in transit. Foremost, they do not cover natural disasters and general averages. Additionally, for those situations that they actually provide cover, they have limited liability, which means that even if you were to get paid, you would not receive the full worth of your consignment if the inevitable actually happens. This implies that in order to avoid getting paid in cents in case of loss, it would be much cheaper and more convenient to get insurance cover for your export shipment. 2. Mandatory requirement. In some cases, for example SIF shipping, it is a legal requirement for you as the seller to take out an export insurance policy for the consignment in order to protect the interests of the buyer as well as bank. This implies that if you are operating under such a contract, it would be a major violation not to take out a policy, which could lead to legal battle or even the loss of the particular deal as well as the client for life. Note that the SIF price and risk transfers to the buyer as soon as goods are loaded onto the ship or flight, and that any contravention of its terms would return the risk to you as the supplier. 3. Loss probability reduction. This one works both ways, such that in case you as the exporter have not paid insurance of export shipment and have not been paid for the goods, or as the importer, you have paid for the goods either in part or in full but they are not insured, in case some sort of damage or loss befalls the goods, then you will without fail suffer major financial loss. 4. Additional control. While the issuer of a consignment might claim to have import cargo insurance taken out and paid for, the best way to exercise full control is by taking the responsibility personally. This is the only way to ensure that the valuation of the goods is done properly and that the terms of the insurance package are actually viable. 5. General average. The speed at which goods are released to you on a general average agreement might depend on you having taken out marine insurance for export goods. The general average requirement stipulates that in case of loss or damage, the two parties to the transaction will share the loss equally. Taking out this kind of insurance would imply that your insurance company undertakes this loss and ensures the fast release of your goods. Types of export-import cargo insurance. In view of these points, it is actually very important that you take out an insurance policy for your import-export consignment. But what kinds of insurance covers are available to offer these benefits? Let us take a look at a number of major options. 1. Export credit insurance. This kind of policy offers you protection in case your foreign client fails to make payment for goods. This is important if for any reason a buyer is unable to honor his side of the agreement. This is one major obstacle that prevents new traders from venturing out onto the international trade domain regardless of its limitless advantages over most other existing forms of trade. This extremely popular policy therefore ensures that you do not have to hold back from enjoying the rewards that come from this type of trade by virtue of fear of failure. It provides a cushion against which to fall back and rise up when the worst happens. The cover offers you the opportunity to avoid a potentially hazardous situation by giving you information on the buyer's credit record and general financial history report. The insurer thus undertakes to recommend the buyer and endorse his capability to make payment. In the rare case that the deal turns sour, the insurer pays between 80 and 90% of the total amount owed in case of loss. 2. Marine insurance. Contrary to the implication behind this name, marine insurance for export goods is not only limited to consignments that are transported over the sea. It is a complex package that provides a cover for goods from the moment they leave the supplier's hands to the point they are handed over to the buyer. There is so much that could go wrong between these 2 points as the consignment moves from the factory to the courier's storage facility, to the selected mode of transport all the way to the buyer. This is the best form of freight insurance to take care of all these terminals and ensure safe delivery of the goods to the client. 3. Political risk insurance. This is a particularly important type of insurance cover for traders dealing with emerging economies. These countries are usually highly prone to interference by governmental authorities that could result in the confiscation of goods or failure to get payment for them. Such governments inadvertently pass laws that might result in blocking the normal channels of money transfer out of the country or even the expropriation of business assets. This insurance covers against the risks that may result from political instability, for instance war, upheavals or riots that might lead to loss or damage. It also covers unavoidable factors that may invalidate your claim to business within the country, for instance the cancellation of your trading license, direct foreigner discrimination that serves to favor local entities and crush the rest, or government contracts that are not honored when political unrest takes center stage. The political risk insurance policy is extremely important because these emerging economies offer the most viable and ripe markets for trade, yet business people shy away from them because of the inherent risks associated with them. This makes it possible to cover your bases while exploring these opportunities at no risks. 4. International product liability. What happens when the goods you ship to your business destination fail to match up to the local legal requirements or are in fact faulty? Simple, you either suffer loss or recover your investment through international product liability insurance. However, this cover does not apply to traders who simply failed to do their homework and ended up in a tight situation. It is only applicable when you have conducted all due diligence and initiated a transaction armed with information, but somewhere along the way some policy detail was amended and now your goods can no longer be accepted into the destination country. It is essential to comply with all requirements in order to ensure that in case such a tragedy actually does befall you, you can prove beyond reasonable doubt that you had made every effort to comply and that the complication only arose after the transaction mechanisms had already been set into place. That is the only way to guarantee compensation from this insurance cover. 5. Currency conversion insurance. A major factor that at times leads to great losses for international traders is foreign exchange conversion loss. The conditions that might have been in play when a transaction was initiated might take quite a turn and leave you in the height of despair. This form of insurance mitigates against any losses that may arise from the negative effect of currency movements. This is highly essential because there is no way to predict future performance of any currency, and the slightest trigger could result in a huge and unexpected change that spells massive loss to an international trader. Important insurance considerations. The kind of insurance cover you undertake will depend on your personal preference. Many business owners choose to ask for 110% of the total value of the transaction. This value covers everything including the courier charges and import insurance costs, and includes that extra 10% to cater for the time wasted and any expenses that may arise from filing a claim. Do not leave these details to chance, as they might spell doom in case the cover taken only allows for a small fraction in compensation or if the claim takes months to settle. Determine the amount of control that you need in the worst-case scenario. On the terms of sale for most transactions, the supplier's liability ends at the point where the goods reach the buyer. In some cases, the buyer agrees to pay for the goods as soon as they arrive. This makes it easier for you as the supplier and could mean that the buyer has a greater need for the insurance than you do. Take advantage of such a scenario. But in case the cargo is being shipped open account, it is up to you to go to any length possible to secure the goods and cover your risks appropriately. Be sure to let the client know his responsibility in reporting any damages as soon as the shipment arrives and not tampering with evidence so as to ensure the claim is settled. It is not automatic that the supplier should always pay for the insurance policy. You could negotiate with your customer on this, as they sometimes agree to foot the cost. It is also possible to find a way to share costs depending on the effect of this cover and other factors considered by each party. There are important documents that should be prepared and retained for the entire duration of the transaction. These are very useful for creating a paper trail that would come in handy as evidence in case you need to file a claim. Important insurance documents. While there are numerous types of insurance documents in the import-export insurance policy, the following are some of the most crucial ones. 1. The insurance policy. This contains the terms and conditions under which the insurance contract is executed. 2. The broker's note. This is the document that you get as proof that a policy has been taken out as you wait for the processing of a certificate. 3. The certificate of insurance. This is also referred to as the cover note, and it serves as proof of the existence of cargo insurance for your import or export. Do not forget to subscribe to my channel. Like, comment and share with your friends. I appreciated all your support. Enjoy your journey.